Hi, my name's Rohan. I'm from Hargreaves Lansdown, the pension provider, and I'm here today to talk you through how annuities work and how uh, this particular retirement option might fit into your overall plan. Just a bit of background. So my role is to go out to companies and individuals and explain the different elements of savings. So that can include pensions, but also ISAs and other savings products to help our clients make well-informed decisions about their personal finances. Over the next few moments, we're going to talk you through why we think pensions matter, a brief overview of how pensions work. I'll cover off the three main income options at retirement, what an annuity is, and the risks associated. The idea here being to help you understand whether an annuity would fit into your retirement plan or not, as the case may be. I expect this to last in the region of about 20 minutes. Do feel free to ask questions as we go through. Just to be clear though, this is not advice. This is purely information to help you make your own informed decisions. If you do wish to seek advice, then we do have an advisory service that may be able to help you as well. So just to begin with, a bit of scene setting. So in excess of 14% of men and 18% of women born today are expected to reach their 100th birthday. And that's far more than those born several years ago, that of our parents and our grandparents' generation. And that in turn means that our pension pots need to stretch that much further for the vast majority of us. The state pension is there to help us. It's currently worth £9,100 per annum if we are entitled to the full UK new state pension. That's payable between age 65 to 68 for anyone aged 43 or older, and will be payable from 68 or older if you're aged under 43. Clearly, some of us may not want to wait that long to access our pension pot. So this is where your company pensions and your personal pensions come in. Furthermore, £9,100, whilst not an insignificant amount of money, it perhaps isn't enough to live the lifestyle that we've become accustomed to. So that's where, again, your personal and company pensions come in. So just to be clear on this presentation, your circumstances are unique to you. So we will discuss how the annuity might fit into your overall plan, and the principles discussed though may not necessarily fully apply to you. So it's important that you listen and understand what I'm saying, ask us questions, and I'll give you some contact details at the end if you are unclear. And just also understand that this is all based on our understanding of the current rules. These rules are subject to change. And as I said earlier on, if you are at all unsure, do seek advice. This is a really important decision for you to get right. So how do pensions work? And the most simplest sort of way of thinking about it is that it's a savings plan to help you save for later life. So the first thing is, of course, to put money in. When you put money into a pension, you do get tax relief at your highest marginal rate. So there is an initial tax saving there for you. Then it's invested. Now, for the majority of us, we are investing for the long term. Even if you are investing near a retirement, depending upon how you do choose to access the pension pot, you may be investing for a long or saving for a long time. So then investing that money. And then the bit that we're all here to talk about today, accessing that pension pot. Typically, you can expect to receive up to 25% tax-free. Now, pensions are only accessible from 55, but that is again rising to 57 in 2028. So there are some clear benefits of saving within the pension: the tax relief to not paying tax on the contributions. Savings inside of a pension are free from income and capital gains tax, but the restriction there is on the age that you can take it out at. So there are three ways to access the pension. As I say, with all of them, you can access up to 25% tax-free. And the main topic here is to discuss the annuity. So the annuity, or an annuity, is the traditional way in which to access a pension. Effectively, what you're doing here is handing over your pension pot to an insurance company, and they're going to give you a secure and a guaranteed income for at least your lifetime. And we'll go through the intricacies of how this works over the next few slides. But beyond that, there are a couple of flexible options available to you: drawdown and taking lump sums. There are some key risks here, though, that with both of these options, it is up to you to invest that money and to manage that investment. The value of investments can fall as well as rise. You may get back less than initially invested. It is important that you are aware of that fact. As we are all aware, so the coronavirus has caused the stock market to drop quite significantly over the previous few weeks. That has meant that incomes for some people in these more flexible retirement options may have dropped. So you will need to be comfortable with the possibility of these drops happening, and be comfortable with how you will cope with those if you choose a more flexible option. So with drawdown, of the amount of money that you move into drawdown, 25% tax-free is paid out to you at the outset. You can then invest the remaining amount however you see fit and take a taxable income from that as and when you would like to. So you could, for example, access, I don't know, £500 a month, but then at Christmas time, take a little bit more, or you could not take any income at all and just use it to access tax-free cash alone. There is another webinar that we have on accessing tax-free cash, and that will explain that option further. Taking lump sums is rather similar to drawdown. The main thing here is that when you access the lump sum, both the tax-free element and the taxable element are all paid out to you in one go. So if you took £10,000 out, you'd get £2,500 tax-free. The remaining £7,500 would be subject to tax at your marginal rate, and it would all be paid out to you in one go. So with drawdown, you can separate out the tax-free cash and the taxable element, whereas with lump sums, it's all paid out to you, as I say, in one go. But do listen in to the other webinar if you have any further questions on that, or would like some further information, or again, I will give you some contact details at the end and our website, and do read up on that. So let's go into annuities in some detail. So what is an annuity? Just to recap what I said a moment ago, of the amount of money that you put into the annuity, 25% tax-free. You are entrusting the rest to an insurance company. Some of these insurance companies you'll be familiar with, some you may not be, as some are quite specialist in this particular area. You are, though, getting a guaranteed taxable income for at least your lifetime. And I'll stress that at least your lifetime element, you can pass it on to your nominees or beneficiaries in the event of your early passing. Just to reiterate, this is the traditional way in which to access the pension, and it's the only really secure way. It is fully backed by the Financial Services Compensation Scheme. You are passing on the risk to the insurance companies, so that it's their responsibility to ensure that you do get that guaranteed income for life. So why use us? We are a whole of market broker. We'll go to the entirety of the open market to try and get you the best quote, and it is our job to get you the highest income possible. We try and manage that process for you as simply as possible. You can start this entire process online by going to our website, or you can contact our account managers. It's completely up to you, but I would generally suggest speaking to our account managers at some point. They can look over your application form, make sure that there's that you are getting the best quote, getting the best information, best annuity for your individual circumstances. It may take a little bit of time, but you know that you are getting yourself an income for life. Certainly spending a bit of time on this is generally very much worthwhile. So who are those annuity providers who is available on the open market? As I say, there are certainly some household names. You've got Aviva, Legal and General. We may be very familiar with those. And then there are some companies that you may not have heard of, such as Just, which specialise in retirement planning and retirement products, and Hodge Lifetime, who are also part of Hodge Bank. So what does affect your quote? So some of these things you can change, some of them perhaps not so much. So the value of your pension is the first thing that will affect it. Annuities are quoted effectively on a percentage basis, and I'll come on to a slide on this in a few moments' time. But the larger your pension pot, the more the insurance company can afford to give you. The next is the underlying annuity rate. So annuities are affected by a number of things. One of the main things being where they can invest the money, or your money. It is invested into things like bonds, so lending your money out to the government and to companies to get an interest rate back for that. If those bonds aren't producing a high yield, then the annuity rates tend to drop. Now, the UK government's base rate is, at time of speaking, is at 0.1%. I believe that's the lowest it's ever been, which does mean that annuity rates are exceptionally low right now. Now, the things that you can change, medical and lifestyle details. While you might not be able to change those, it is important that you give as much information as you can. And I'll come on to that point in a few moments' time to show you the differences that you might expect depending upon how much you do or do not disclose. And the last thing is the shape of your annuity. This is whether or not you want to pass what you want to pass it on to your nominees or beneficiaries, whether or not you want the annuity to increase in line with inflation, and those sorts of considerations. And again, I will discuss these in further detail in a few moments' time. So, as I said, lifestyle and medical details are vitally important for you to provide. They can only be factored into your quote when you start the process. If you set up an annuity, you can't subsequently change it. So it is important that you get all these details right at the outset to enable us to get the most appropriate quote for your individual circumstances. In excess of half of the clients that went ahead with an annuity with us in 2018 qualified for an enhanced rate. In actuality, that includes people who did not provide us with any information at all. One might reasonably expect the figures to increase if I only included people who had provided us with medical information. Nonetheless, the majority of people did get an enhanced quote, so it is worth providing it so that you can be in that majority. And here, as I say, shows you the differences depending upon the details that you disclose. Now, whilst I don't wish for you to have a stroke or anything, if you have had anything serious, clearly the amount of money that you might expect is higher, and this graph bar chart does show that. This is all based on £100,000 being paid over to the annuity provider, and so the person in this case with a stroke got in excess of 7% of their £100,000 out each year, whereas someone who didn't provide anything got sort of 4.8% in this case, or thereabouts. Unfortunately, it is the case that the shorter the annuity provider expects your life to be, the higher the quote they'll give you. So not getting a high quote can be seen as a good thing. It does mean that you are expected to have a long life. The flip side being that if you are expected to have a shorter life, then you might as well get the highest income that you possibly can. So this is the bit where we start discussing the shape of your annuity. So the first thing, and one of the main considerations people have, is passing on their savings to their loved ones. So there are predominantly three ways in which you can do that, and I'm just going to discuss them here. So the first is a guarantee period. This guarantees the minimum length of time that the annuity will pay out for. Importantly, not the maximum. So if I just give you a brief example, let's say that you had a 10-year guarantee period. and lived for 5 years after setting up the annuity and passed away, it will continue to pay out for a further 5 years to your nominees or beneficiaries so that it hits that 10-year minimum. If, however, you lived for 20 years and passed away, well, you would have lived longer than your 10-year guarantee period, so at that point the annuity would die with you. The next option is value protection. This is when you guarantee the capital sum that you paid over to the annuity provider. So let's say that you paid over £100,000 and got £90,000 gross from your annuity provider over the course of your lifetime and passed away. Well, that's £10,000 that you passed over but never benefited from. So in that case, if you had value protection, also known as capital protection, that £10,000 sort of residual amount would be passed on to your to your loved ones, typically as a lump sum. The last option here is a spouse's pension. This is effectively if you predecease your spouse, then you can nominate for a certain percentage of your income to be paid over to them. So that could be half of what you received or 100% of what you received, completely up to you until they pass away. So you can ensure that your other half, that your spouse is well catered for in the event of your early passing. It is on occasion possible to sort of mix a couple of these options up. Typically, you would mix up the guarantee period and the spouse's pension. So you could have a guarantee period, for example, of 10 years, and then after that, the spouse's pension may well kick in. But if you do have questions on that, then as I say, do contact us at the end, and we can go through some further. We can discuss that further with you. So the next thing to worry about is inflation. So inflation will erode the purchasing power of your money over time. If you take the last 25 years, the cost of goods and services has effectively doubled. So if you had a basket of goods costing £1,000 25 years ago and tried to buy an equivalent basket of goods today, it would cost you about £2,000. Therefore, if your annuities is not increasing in monetary terms each year, then you may find that over the long term, and I do hope that you have a long and happy retirement, that over the long term, your purchasing power does get eroded. Now, it's important to point out that you may have other sources of income. For example, the state pension that I mentioned earlier on does enable you to, well, does increase in line with the triple lock, which is inflation, 2.5% or average earnings. So that may well provide you with some protection against inflation, but if that's not the majority of your pension, then you may want your annuity to increase in line. So you can link your payments to a measure of inflation, such as the retail prices index, or you could alternatively specify a rate of increase, such as 3%. Now, the online sort of search tool on a website enables you to do either. So do play with that. If you want something that's not available on the online tool, then we may be able to get that for you. Again, just contact us. Bear in mind that the Bank of England targets inflation at 2%. So if you were increasing at 3%, provided that the Bank of England does achieve its inflation targets, then you should be okay. Do also bear in mind that initial payments will be significantly lower if you do opt for increasing payments. Again, I'll show you a table of a few rates in a few moments' time, and that point shall be made, I expect, somewhat explicit then. Now that table is here. Across the top, you've got a few ages. So you can pick the one that's closest to yourself. You'll note that the minimum age is 55. That's because that's the minimum age at which you can access your pension currently. And then down the left-hand side, you've got a few types of rates. So at the very top, you've got single life, level, no guarantee period. So single life won't pay out to your spouse in the event of your early passing. Level won't increase with any measure of inflation. No guarantee period will effectively mean that the annuity stops paying out when you pass away. As you look beneath that, you've got some joint life pensions at the bottom. You've got a few types of escalation. So you've got RPI, which you can see has a significant impact on the payments, and you've also got sort of 3% as well, which does not impact the initial income as much. And then you've also got some guarantee periods in there. This table is just there to give you some indicative rates. It is quite possible that you will get a higher rate depending upon your health conditions, or potentially sort of fractionally lower as well. And it's also important to point out that the options there on the left-hand side are not the totality of the options available to you. You can have guarantee periods much longer than 5 years. And you can also have escalation rates that are not 3% or RPI. You can have a few other options in there as well. So how is your income taxed in retirement? 25% is typically tax-free. It's not subject to national insurance, so pensions income, whether you're accessing it via drawdown, taking lump sums, or annuities, is not subject to national insurance, but it is taxed as earned income. So in the same way that your earnings are taxed, this is taxed as well. And your pension provider will deduct tax as instructed by HMRC. So we get a tax code, and we deduct tax, as I say, in line with that tax code. What are some of the key risks? So factors to be aware of. So they can't be cancelled or amended once they're set up. So it is vitally important that you do consider all the options available to you and make the one that is most appropriate for you at the outset, because once it's set up, you can't subsequently add in a beneficiary, add in medical details, any of those factors. And equally, you can't factor in inflation proofing once it's set up. So do bear in mind the risks of inflation. If you do not provide accurate medical or lifestyle details on the application form, your income may be altered. So if you say that you smoke a significant amount more than you do, or that you've had a medical condition that you do not, and the annuity provider checks, then you may well find that your annuity rate is decreased. On the flip side, though, I was talking to an annuity provider, I suppose about a year ago now, actually, about this, and they said that a number of their annuities where people had cancer, when they subsequently got the cancer details, they did increase those payments for a number of those people who had cancer, because their initial declarations didn't tell the annuity provider the severity of the cancer that they had. So that can work in both directions. I would suggest that it's worth making sure that you get it right first time. Clearly, it's nice to get a small increase, but it can be somewhat problematic if you get a decrease. So do ensure that you get the most accurate information that you can. The next point down there, so annuities can't be passed on if you don't factor that into your initial quote. I think I've covered that already. Basically, make sure that you do consider all the eventualities when you set it up. The last point, the cost of delay. The older you are, the larger the annuity, the larger the amount the annuity provider can afford to pay you, and that's effectively because you've got fewer years until you're expected to pass away. However, you are missing out on income in those years between now and when you do eventually take the annuity, if it is indeed an annuity that you opt to take. So there is a trade-off there to be had between sort of deferring taking the annuity so that you get higher income per annum, and sort of taking it now so that you've got income sort of kicking in immediately as well. So some options to bear in mind. I suppose one of the most important things to bear in mind is that you don't necessarily need to use all of your pension for any one option. So annuities do provide a secure income, but flexible retirement options, drawdown, lump sums, do have their place in your retirement planning as well. Different options will have different benefits and risks for different people. So do please investigate all of the options, and then you can sort of split your pension up in multiple directions so that you can get the combination of options that work best for you. You can normally move from flexible options to sort of annuities in the future, but you can't move from an annuity back to a flexible option. So do bear that in mind as well. There is a retirement planner available on our website. It enables you to put in a few inputs, the amount of money in your pension pot, how much secure income you want, and then it will tell you how much flexible income you could expect. Do feel free to play around with that. It will give you some good ideas of how much to allocate to annuities, how much not to allocate to annuities. That can be quite helpful. As ever, if you're at all unsure, please seek advice. In addition to advice, there is PensionWise. They offer a free impartial guidance service to help you understand the options available to you. It is a government service, but they do offer face-to-face meetings, telephone consultations, and their website is actually really good as well. So I would strongly sort of urge you to seek as much information about your retirement options as you can, and PensionWise is a reliable source of information to get that. Please take a look at the details on your screen now, so pensionwise.gov.uk, or give them a call on 0800 138 3944 if you have questions. As I said, do feel free to ask us questions if we can help you. We have a dedicated retirement team. Contact them on 0117 980 9940, or just email us at retire@hl.co.uk if we can help you from there. We can walk you through your options. We can run annuity quotes for you. We can talk you through drawdown, lump sums, so on and so forth. Do make use of these services, please. So, three key things I want you to walk away from this sort of webinar with. Firstly, decide what sort of income do you want. Do you want it to be secure? Do you want it to be sort of flexible? And how much secure, how much not? What sort of risks are you happy with? Do you want to pass it on? If yes, in what way? Do you want it to be passed on as a lump sum or continue as an income? And are you concerned about inflation? And how do you want to combat the effects of inflation on your future, or in your future? There are, of course, many other questions that you could be asking yourself, but these, I think, are the three key ones that you should be thinking about when you do determine whether or not annuity or what retirement option is appropriate for you. Hopefully you all understand everything that I've said. Do feel free to use those contact details. Contact us if we can help you. Do also please take a moment to read through this slide just to make sure that you're all okay with everything that I've covered today. Thank you for taking your time to listen in, and do feel free to ask questions now. Thank you.